They've capped premiums in California. They've also mismanaged their water. They've also, under the guise of environmentalism, let deadwood build up in these forests. They have like 8 or 9 fires a year.
The farther below standard you are, the more expensive it's going to be to buy that death benefit. They had to charge more because the risk was so much higher. The likelihood of your house burning down is higher there in LA. This person that has kidney issues and liver issues and is overweight and is pre-diabetic, the likelihood of them dying before me and you is higher.
If you live in LA, the equivalent of saying that I want this rating, well, you're a 1. It means you're likely going to burn down. And so you're going to be priced differently. But doesn't that tell you something? Doesn't that tell you that you probably need this?
There's a certain likelihood that these neighborhoods could have a fire risk. And every year the risk is getting closer and closer and closer because it hasn't happened.
What good is an accumulated pile of assets? What good is this nest egg if one move can wipe it off the board?
We're live, man.
What's up? What's up?
Welcome back.
Good to see you again. We're down here in Southern California, which has been in the news lately.
Yeah, you guys are unaffected, right?
Yeah. It's we've been getting a lot of texts and stuff because we're in the region, but a couple counties over, and really it's another world up there. There's no comparison between San Diego and Los Angeles. It's about 2 hours, but then there's always LA traffic because that place is a shithole. But I was writing in our newsletter, working on our January newsletter, and if you read it, it'll sound a lot like our conversation is going to be today. But we thought there's a lot of interesting takeaways from this. So before we get into that, what's new in Pennsylvania? You're not burning down.
No, we're not burning down here. We're snowed in. It's been snowing a lot for at least a week, pretty regularly. So kids are home from school today. Roads were a little bit covered. I was driving home from this morning, but not too bad. Just a little cold. It's been cold and snowy, but all good, man. It's part of living here.
It's a legit snow day today?
Yeah, but they're like real weenies about it, man. It's like they call it based on forecast. It's not even exciting anymore. There's no daring to it anymore. They don't even let the kids take a risk. But it's good. It's it's fun. Everybody's home and probably get loud here at some point. But yeah, I enjoy it, man. I don't mind the snow. It's like it's wild. Like sometimes you get sick of it, but I don't mind it at all. It's fun.
Yeah, this is the time of year when people are telling us how nice it must be to live somewhere where it's always 70 degrees, and you can't complain about the weather here. But I love winter, and like being in the winter and not actually experiencing it always makes me ready to go and
move north.
I'm pretty ready for our move to New Hampshire, most likely.
Do you ski or snowboard?
Ski, yeah. My wife snowboards, I ski, and I'm really excited to take my daughters and teach them. I absolutely love skiing. Yeah, we had a scare the other day. Not a scare, but the bird flu, the next fake pandemic is hitting the shelves here. And so we haven't had, like one cool thing about California is that you can get raw milk in the grocery store. And so the little market down the road from us here on the island, we get raw milk there all the time. It's all we have in the fridge. It's been out for like 2 months now because of bird flu, which is infuriating. They manufactured a pathogen and used it as a political story to shut down production of food. I think, clearly, like raw milk is superior in every facet to pasteurized milk, but even the regular milk now is really bare on the shelves because the bird flu, which is quote infecting flocks of chickens, somehow is worthy of shutting down milk production. I mean, it's the full scale retardery you've come to expect from California. It's like, yeah, well, this factory farming model, of course, you have to pump those things full of vaccines and just chemical compounds just because they're living in. It's like, yeah, people are unhealthy living in the ghetto or living in like a squalor. Yeah, so you have these chickens, you have these cows. Yeah, of course you need to modify all this stuff because the scale that you need to do that to feed people who can't feed themselves, which is most people now, myself included, it's like, yeah, of course you need to have these high volumes, but the problem is the actual solution is not just pump them full of more chemicals and just dumb down and make the food supply even shittier. It's encourage people to have their own flocks of chickens, encourage people to have a cow share, whatever it is, like make raw milk accessible, make healthy milk accessible, make healthy eggs. Like Coronado here, you can't have chickens.
It's not even about making it accessible. It's about not interfering with people's private rights too.
It's such cuckery on our part that we accept that. Like, how do we think the state has the right to tell us we can't have chickens? Of course they can't tell us that. And so people need to just give the finger to the state and just start have your own chickens. They do not get to tell you cannot do that. No, zero city, like no, there's no authority that says you can't have chickens. and anybody in the country. It sucks that we've accepted that, but I think that's hopefully starting to change. But when I saw, and then the other, like the final thing for me in the store was like, all right, milk's been scarce. Raw milk has been totally gone for 2 months. And now like the eggs on the shelf are bare. And so I was like, in my head, I moved up our timeline to get out of California like way sooner. For those who don't know, like we have this phenomenal deal where we live in this beautiful little island. So like it's a really hard deal to walk away from, even though I know that being in California is not sustainable, and it's pretty much a bad decision for anyone in like who's not in actual Northern California. Like Jefferson, the free state up in Northern California, that's a good place to be. But basically, San Francisco and down, you can't justify it economically, and I know that. But we just have such a phenomenal deal here. But when I saw that, I was like, all right, we got to move like now. But then I texted my buddy in New Hampshire, and he was like, yeah, we haven't had eggs here since Christmas, so it's a nationwide thing. I'm skeptical, but I'm hoping that the incoming administration, they're talking a big game about this stuff. So like, it would be awesome if we did see raw milk just become legal, like the FDA just shut them down. But I doubt it.
We're allowed to have it in Pennsylvania. That's all I've exclusively drank for over 20 years now. It's all my kids don't even like they're like those they shake if you give them regular milk in a container like school, like they shake it because they don't know that they don't have to.
Yeah, when I was in Virginia for that punishment tour last year, we had friends who were part of a cow share where they pay in to like own a cow with a group and have pickups, and then the milk is labeled for like pet consumption. It's just insane what you have to do to try to be healthy in America. But absurd policies by terrible leaders. You always hear authoritarian, fascist like thrown around by people like at Harvard. That was the buzzword. Like anyone on the right was just a fascist. And it's like you don't know the definition of that word, but by actual authoritarians like Gavin Newsom, like every blue city, horribly run cesspools. It's not surprising that Los Angeles is burning down. They have tons of fire every year. They mismanage everything. You cannot have diversity and inclusion as your primary agenda item and not have terrible failures like the Bull Dykes, running the LA fire department with empty reservoirs. Shipping firefighting equipment to Ukraine actually happened. That's absurd. Cutting of the budget, all this stuff. Like, you cannot have such preposterously bad leadership with a focus on diversity and inclusion as their number one thing and not expect something like this to happen. So there's a lot to say about that side of it, and it is being said, and the criticism of those people is fully justified, and they deserve all of the criticism they're going to get. Of course, nothing's going to come of it, but we want to take away a few things, because I've been noticing a lot of things we talk about on the IBC financial strategy side of our conversation seems to be playing out in an unfortunate way. And of course, it goes without saying, sympathy to the people suffering for this, right? Everyone in the world is, oh, my sympathy for whatever. Like, yes, of course we have sympathy. We're not minimizing the suffering there, but everyone's saying it, and it doesn't really matter what we say it anyways, because it doesn't help or hurt anyone if we send thoughts or prayers like in this kind of vein. Like, if we have legitimate private prayers, like I believe there's power in that. But if we're just like saying it, it doesn't really matter. So of course, caveat all of this with, we're not minimizing the suffering people are going through, but we're going to try to pull some lessons out of it. Any lessons that you're seeing off the bat of like how this ties into financial strategy and foundational planning?
Well, there was part of, like, if you just think about the insurance side of it, there was like, you've seen this in the news, and it's kind of been an attack on, I think State Farm was the company that's kind of been under a little bit of a public attack because of just what people don't know, and trying to find somebody to blame for things. But a lot of people lost their insurance coverage on homes that are mostly valued over, or many of which are valued well over into the seven figures.
The average home price that I read that of places that have been burned down is the average price was $3 million.
3 million. Okay. Wow. So the average is 3 million, which means some are way more. And a lot of these places have gone uncovered for various reasons. And actually, I know a little bit more about some of those reasons, because you spoke with a property attorney in California who kind of gave you a little bit of insight into that side of the world, and why these people lost their property coverage.
Yeah. And so, of course, like, you see all the stories flying around demonizing State Farm, demonizing these carriers. Like, how dare they pull these poor people's insurance policies? No. Pull the mask off under the Scooby-Doo hood, and who do you see? Gavin Newsom. These same criminals, people who are not working for the interests of their state, they've capped premiums in California. They've also mismanaged their water. They've also, and under the guise of environmentalism, let deadwood build up in these forests. They have like 8 or 9 fires a year. Like a fire in LA is not an uncommon thing. The Hills of LA Are Burning is literally a song, Black Flag song from like the 90s, I think, or early 2000s. The Hills of LA Are Burning, right? That's not an uncommon thing. To this degree, though, seems to be unprecedented. So there might be some trickery going on. There's speculation of like some ulterior motives, but without getting into that, you have empty reservoirs, you have firefighting equipment shipped to Ukraine, you have dead wood building up under the name of like preserving and like this environmental push. So you can always trace it back to these absurd policies. And I'll say Democrat because every city is a Democrat city, but like it's not just Democrat city, it's what the people there tolerate and accept, which is in the name of not being shamed, like the classic, I don't want to be shamed. I don't want to be, I don't want the social shame. So don't call me names. So sure, I'll go along with whatever it is, environmentalism, anything, you name it. But it sounds good. We want to protect the environment. So we're not going to do anything to these forests. Okay, well, now your forest burned down. It sounds good that you're going to cap premiums that insurers can pay because we want to protect the consumers. So yeah, these quote evil insurance companies can't just keep raising the premiums. Well, what happens when the average home is worth $3 million?
Well, hold on. So that's the problem. Like, the question I asked is about the insurance companies and some of the insight that you gained talking to somebody in the property casualty world, the capped premiums. So that's what I was wanting you to talk about.
Bringing it all back to that, like things look good. Like you present it as like, it looks good on a tweet. We're trying to protect the environment. We're trying to protect policyholders from being exploited by insurers. Like it looks good, but here's the result is it's not like they just said your policy is canceled. They just said, we're not going to renew it because we can't charge enough because the cost of, due to inflation, the cost of rebuilding a home has gone up. We're talking about million and million. Like if average is 3 million, like we said, there's a lot of homes way more than that. If you're an insurer and we're like, hey, there's like 10 fires a year in LA alone, chances that this house burns down are whatever X percent, the chance we're going to have to rebuild a $10 million home, well, we need to charge premiums commensurate with that, with the cost of rebuilding a home now. And so they need to raise premiums because, like, what are they insuring? If they can't raise premiums to match their risk, it's not like they're just, it's not like surge pricing or exploiting. Like it's literally like just it's an actuarial equation. We're gonna go out of business if we have to rebuild these homes or take on that risk. Like the same thing we talked about last week with term insurance. If like all of a sudden instead of 1 person out of 100 dying in their term, now it's 10 people, well, the price has to go up or they're just not going to offer term policies.
Yeah, well, and that's like that kind of makes me think also about people saying that whole life insurance is too expensive, and especially as you get older, like the price is too high, and it's like, well, they have to charge that because the likelihood and the risk that the company's insuring against is higher. So I've had people that end up getting what's called a table rating, and I know we've talked about it, but you get all these ratings on whole life insurance, and you can get, it depends on the company, they're all named differently, but like super preferred, standard is the one that everybody has, and then there's below that, and they'll give you a whole table of maybe 10 different levels below standard for that accommodate different risks. Sometimes they're health risks, sometimes they're lifestyle risks, but for whatever reason, the farther below standard you are, the more expensive it's going to be to buy that death benefit. And a lot of people, they kind of freak out and they're like, well, I don't want to pay for this if it's so expensive if I'm not standard. But it's like, well, there's a higher risk for you. This is why you actually should pay for it. And that makes me think about these homes. People eventually are like, they're like, well, we can't pay that much for this property. Well, they had to charge more because the risk was so much higher that the likelihood of your house burning down is higher there in LA. The likelihood of this person that has, kidney issues and liver issues and is overweight and is pre-diabetic, like the likelihood of them dying before me and you is higher. They have to pay more. And that's actually the point at which you probably should want to pay more to make sure you have the coverage for that asset. The one asset being your home, the other asset being your ability to earn income, like we always talk about. So there's very good parallels here. And what the insurance company did in LA by pulling out, because it was just like, well, we can't renew these because there's no price at this point, which is the place where you're uninsurable in life insurance. That's the parallel there. There's no price point now that makes sense to have to pump out billions of dollars in rebuilding if these neighborhoods go up, which they did.
And this is just like, the analogies here are so rich to what we talk about all the time. Like, I feel like this event is poking 1,000 holes in the buy term and invest the difference argument. and the typical attacks that we get. Because, all right, I live in Southern California. I live on an island called Coronado off the coast of San Diego. So I live 2 hours away from where some of the worst fires in history just occurred this month, right? I could get fire insurance on my home because I live on an island surrounded by water that has a marine layer that's almost always like 3 quarters of the year on top of it. And so, even though geographically I'm very similar to LA, I could get fire insurance because it stays fairly damp here on the ground. We have literally a natural water break around the island. So even if fires were in San Diego, like the conditions in San Diego are not the same as LA, to where people in San Diego could get fire insurance, but we especially could because of the island, because there's literally a body of water surrounding us. And so you could call my house a preferred rating for fire. Probably not compared to you. The risk for you is even way lower. So maybe I'm like, you might be the top tier. We'll just call it 1 through 5. Like you might be a 5 on a fire insurance rating. I might be a 3, but compared to LA is now a 1. So if you live in LA, the equivalent of saying I'm going to like this is too pricey, I don't want this rating. Well, you're a 1. It means you're likely going to burn down, and so you're going to be priced differently. But like you said, doesn't that tell you something? Doesn't that tell you that you probably need this if the company who specializes is saying the cost to you is so high? Now, let's take another analogy. Why don't you talk about 1 year renewable term? And what does that look like in this situation? What does it mean a year ago to now as far as your cost of fire insurance in LA?
Maybe it's next to nothing because how often does an event like this happen? When you rebuild, maybe it goes low. But yeah, every year that goes on, I would almost think of it. And there's multiple ways that we could attack this analogy, but one of them is like, hey, there's a certain likelihood that these neighborhoods could have a fire risk, and every year they don't. You're minimizing the risk is getting closer and closer and closer because it hasn't happened. And it's like, if I have this inevitability over a period of time that it's going to catch fire, there's going to be 6 fires a year. Who knows geographically exactly around LA where they're going to be, but it's every year there's going to be them. They're going to exist. And at some point they're going to touch this neighborhood. Well, if they didn't touch it for the last 4 years, it's like your time is coming. So if your time is coming, they have to charge you a little more because it's like, hey, we're going to be rebuilding this in the next decade potentially. I mean, there's one analogy with the renewable term. What else you got?
Yeah, just thinking, if you would ask someone like when these policies were expiring a year ago, again, it's not like they just canceled coverage. They just let the policies lapse. They said we just can't renew this. And so if you have to go through re-underwriting, go through a reapproval process each year, whether you have 1 year renewing term or just term policy in general, like call it a 10-year term policy, but 10 years later, you will have to go through underwriting again because there's no permanency, because you are paying a lesser premium for the fact that they get to reevaluate at a certain time. So with these policies, a year ago, they said, hey, we're not going to be able to renew this. When your premium, we flash back to January 2024, maybe people are getting letters saying, hey, come July, your policy is going to expire for this year and we're not going to be able to renew it. So what are you thinking about then when you get that letter? Well, you're thinking different now if you got that letter today. If you live in LA somewhere where the fire hasn't hit, if you have a still standing home in LA and you get that same letter that people got a year ago, your mindset, you think differently. Is that worth it now? Is it worth the risk? Would you take that lower rating, the substandard? Yeah, you're probably going to take it now and pay a higher premium because you understand, look what just happened.
As you were saying that, I thought of something else, is that each time that is going to renew, or if we use a short-term term, because you can even buy 5-year term and policies out there, not with the companies we work with, but they exist. So if you get these short-term policies, things change. So in 5 years, or if you get a 10-year term and year 11, or maybe in year 8 while you're covered, everything changes. Like your health, your life circumstances, your income, all those things are different. And what if now you're not insurable? So in the same vein, when you're talking about these policies based on these inept elected officials have changed. And so maybe these environmental policies have shifted from whenever State Farm or whomever first wrote a policy. Well, maybe they cleared all that stuff out. Maybe there was better policy, maybe there was better protection. And I'm not pretending like the insurance companies are outside of the world of, all this DEI and all the crap that created the bad policies. Some of them are probably just as guilty of thinking in the same way, but all that stuff changed. So maybe on the environmental side, like you're no longer allowed to clear the leaves and the brush and the dead wood around your houses, where 10 years ago you were, meaning there was less of a fire risk. Just like that, while those policies changed and there's nothing you could do about it, I can't do anything about it if I get some sort of well, maybe lifestyle, but I'm saying like if I got a metabolical disease, or if I get into, something happens, I get into an accident, smash my head in a car accident, can no longer work, can no longer hold a job. I'm no longer insurable either because of this brain damage. Like that's not even my fault. Anything can happen. And now I'm not covered.
Yeah, and so that gets to something we often say, when we're comparing what we do as far as financial strategy, our outlook, our paradigm, we often say, comparing it to the CFP model, what good is an accumulated pile of assets? What good is this nest egg if one move can wipe it off the board, like you were just saying? And the analogy we often give, like, again, is that car accident. What if you get sued? What if you're determined to be at fault, causing injury in a car accident, and now you have $1 million, a $2 million debt to pay? We often say, all right, let's look at all these game pieces on the board of your overall financial picture. Here's all of them laid out. We use I like to use the elite model, which shows everything on one playing board, right? So, all right, here's everything you got. Circle the ones that will survive intact a $2 million lawsuit, for instance. And most people don't know. Most people don't know which assets are protected, which of these assets are protected against liability here. If you do know, well, how many of them actually survive intact? What does your nest egg look like now? If you have a $2 million nest egg and you get a $2 million lawsuit, are you surviving that? Well, the strategy we put in place mitigates that.
And right here, like there's these two parts of wealth. There's the protection, and then there's the wealth path, right? And if you think about some of these folks, and like LA is actually a perfect example because they're really unfortunate in what's happened to their property and their net worth and their homes and everything that's gone with that. But some of them may have bought those $3 million homes for 700,000 20 years ago, 800,000, whatever the number was, I don't know. And so they're tying up their wealth in that equity in their home that has just, blown up in the last 20 years, 25 years. So if that's the case, we talk about how those two paths are parallel to each other. You have to be protected. And we always talk about protect first, save, then grow wealth. Well, if their wealth was all tied up in here and they don't have natural protection because of everything that's materialized in LA, their wealth, it took one hiccup. It took one natural event of a fire to destroy it because the protections was not in place. They now cannot rebuild that home if they were one of those unfortunate people without home protection. So the lack of protection just destroyed their wealth. And imagine if they did buy it 25 years ago. That means they're probably in their 50s, maybe 60s. That the time horizon to build wealth now is not in their favor because wealth gets built over time. So by not having proper protection, maybe not any fault of their own, but it's just so important to have that somehow in whatever ways you can. So maybe don't live in LA on the property side, but here's a place that we often talk about what we do when it comes to the whole life insurance is protecting your number one asset, which is you and your ability to earn an income. And we can protect that, especially if we're healthy. And if we're healthy enough to protect it, it's imperative that we do. Like accept that table rating if you're on it and then try to get healthier. Things like that.
Your life is the house in Pacific Palisades. It's going to burn down. Last time we talked about, your life is a car that's going to be totaled with certainty. Okay, your life is a house that's in Pacific Palisades and it is going to burn down. So what are you doing? What are you leaving behind? All right, we'll take our 90s couple, Bill and Diane are, they went through the Financial Peace University. They're getting their mutual funds. They maxed out their retirement accounts. They bought the mutual funds that are going to do 12% per year guarantee, with average 12%. So it's always going to go up, right? They bought term, they invested the difference, even though we know from our last conversation, they didn't actually price it out and buy, figure out the difference and invest that. But they did buy term. They bought 30-year term policies in their 30s. This is back in the 90s, 1995, we'll say. And so, now they've done the Rave Damsey approach. They've done the CFP model. So they turned 65 this year, 2025. They have a home in the Pacific Palisades that they bought in the 90s for $500,000, and now it's a $4 million home. Their term policies just expired, and they have a $4 million nest egg. They did really, really well for themselves. So you would ask them 10 days ago, 20 days ago, you're living you are doing the CFP dream, right? You have a $4 million house. You have a $4 million nest egg. You are self-insured. If something happens, you've got the money to cover it because you are living off of these assets. Okay. Fast forward to today, your $4 million house burned down. You don't have homeowners insurance on it. That part is kind of out of your control to a degree. Now you could have renewed it if we're looking at hindsight. but I get it. Like you see that steep bill of, hey, State Farm's going to drop my coverage. Something I got to come up with something. These bills look off the chart. Let's just take a pause. We'll figure it out what we're going to do. We'll expose ourselves for a little bit, figure it out. I do understand how you see the price tag that it's going to cost to fire insure and be like, I'm not $2,000 a month, whatever. Like, I'm not paying that. I get why people didn't, but now we look back. And so now you have a home burned to the ground. You're going to get $0 from insurance from that. Now your net worth is cut in half. So you still have your $4 million, but what is that going to do? You're not leaving a home to your family anymore. You're not getting anything out of that home anymore. So are you going to rebuild the home? If you do, insurance, if you had insurance on it, they would have rebuilt a $4 million home for you. But now you were self-insured. So you have $4 million. Are you going to put it all into the home?
And now we've got other questions on lifestyle. Like, are you going to rebuild in this same place? Like, are you willing to risk it again? And can you afford to build an equivalent home? We all grow into a certain lifestyle, and most of us don't want to downgrade that. So you were living in this probably beautiful $4 million home. Are you going to go build a $500,000 home in the Midwest after you've lived in scenic LA for, maybe not, I don't know. But the problem is, now you're faced with crunch time. You have decisions to make. You have $4 million in cash. Does your lifestyle completely change? Do you buy a lower home? Do you have to move your family? Now you have to think about like, all right, well, I was going to live on this 4 million. I was going to live on the interest of this 4 million, as they say. And as Rafe Damsey tells you, you can take 8% and still be positive because it's going to do 12%. So whatever. So now, even though that's a fantasy, but you were going to use that approach to live on the rest of your life, but you just cut it in half to rebuild your home or to move your family, or you cut it in a fourth. Now what happens to the quality of your life? And the analogy you've used on this show before, you've talked about the barrel water analogy. If you're stuck on an island and there's no fresh water on that island, and in floats in the ocean one day a barrel full of fresh water, what do you do with that fresh water? Are you gonna drink it all as fast as you can and rehydrate your body, or are you gonna sip on it, preserve it, be a little bit underhydrated all the time? Is another barrel coming? We don't know. So they're facing all of these choices. If I use this money to build this house, like what if we have an inflationary thing? What if we run out of money? What if we live to be 100? All those issues they're now facing that they weren't, simply because there wasn't a good protection in place.
And that just belies the myth of self-insurance. It's not insurance. It's a one-for-one replacement at the expense. It's like you're not self-insured. You're just moving money from one pocket to the other in this event.
I can't even, like, just on the simple face of self-insurance is so dumb. Like, we're insuring our ability to earn income, and maybe we don't earn any income anymore. We're 70 or 80 now, but we're insuring an equivalent amount of our assets at that point. It turns into like an asset insurance. Like, but nobody purposefully stops paying for their car insurance just because they're not like, I've got enough money in this mutual fund or in this savings account, I'm just gonna let it burn. Like, I'm just choosing to not pay. I mean, some of them did their, ironically, as I say this, in LA, but most people across the country who aren't facing what they were facing when it came to the renewals don't choose to just not insure their house, because they know that if that house burns down, it will devastate them financially, especially now that they don't have the ability to necessarily earn the same kind of income if they're 78 years old or 80 years old. So self-insurance is just a myth all the way across the board. It makes no sense.
You can't self-insure. You can just move money around. When that event happens, this one event that wipes something off the board, in this case, it's not, you can't even call it a black swan because it's not unexpected. It's the most predictable event in the world is that LA is going to catch on fire. Like, it's every year. And so it's not even a black swan. It's like a rainbow swan hopping around trying to get your attention. That happens. And so you suffer a loss, and self-insurance just means, okay, we went from our $8 million net worth that we valued down to 4. And now that 4, we can either keep the 4 in the brokerage account and mutual funds, or we could move the 4 to the home. But like, the idea of insurance is that if you take that loss, you get back up to 8 million by someone else covering the cost to get you back to 8 million. That's the principle of insurance. But in this case, you're not getting back to 8. You're staying at 4. You just have to reallocate that 4 somewhere, but you don't get back to 8. So there's no such thing as self-insurance. And it's unfortunate that we have such a prescient, timely reminder of that question we always ask, going back to the beginning. What good is your net worth if one move can wipe it off the board? And in this case, a lot of people, unfortunately, are experiencing that. I hope none of our listeners are going through that right now.
Yeah, I hate to see anybody go through it. It's awful.
Yeah, and again, we're not minimizing that. We want you to take these lessons because there's no reason not to learn from this situation and look and where you're at. You're in Florida, you're not at risk of burning down, but you have similar risks here, right? People in North Carolina until a couple months ago, did not think of a flood ever wiping out their life. But people might be experiencing the same thing. And so if we bring this analogy back again to your life as that house, and it's going to burn down or it's going to flood, it's going to be wiped off the face of the earth. We know that with certainty. So you have a problem, which is that you're underinsured. You also know you're going to die, and there is something you can do about it. So if you are not doing something about it, that's a choice you're making. And if you are the breadwinner and you're not thinking through this stuff, you are leaving your wife, your kids, like, do they know you've made this decision for them, that if something happens to you and your house, the house of life, like, you burn down, you die, do they know that you made this decision, that you're not going to be replacing what you brought to the table? Do they know they're going to go from 8 to 4 and have to live with 4 because you made a decision not to replace the 8? Like, do they know that that's a decision you're making?
And not just that, but you can replace it with an asset that actually makes everything else in your financial life stronger. It's not even something that's just a payment going out the door, which is the way it's pitched in many cases. But yeah, permanent life insurance, especially whole life insurance from a mutual company, is going to give you a better savings rate. It's going to give you better leverage. It's going to enable you to do more with your other investments with more certainty and guarantees. So it's not even like you're just funneling money out to hope that nothing bad happens, or you're not just paying a bill. That's the crazy thing about it. Whereas, as opposed to all other insurances that are insuring against a potential outcome, this one's insuring against a guaranteed outcome. That it is aggravating when, now here I am, I've been driving for 27 years or something. Yeah, I've been driving for 27 years paying insurance, and I've never caused a car accident. So it sucks. Like, so for 27 years, I've paid a lot of money and have never needed it. And it just feels like a bill because there's nothing to show for it. This is a totally different kind of insurance. You actually have, it's actually an asset. So first off, it needs to be declassified from all of those other insurance products, because it's an inevitable outcome that's matching a guaranteed event. Your death matching a guaranteed payout with the access. And if you go back to our cash value one, to that cash value and all those living benefits throughout your life. So it only makes your life better.
It's hard to see that happen. And like I said, if you read our newsletter, you'll see this conversation. The thoughts that I've conveyed here is more elaborated than what I can put in the newsletter. But I just want everyone listening to take something away from this and really think about this and put yourself in the situation of, if you're doing the buy term and invest the difference, if you're doing the self-insured accumulation model, all these things we talk about just collide in a very painful exposure here. And if you've thought through this and you decide that the accumulation buy term, if you decide that those are the things for you and you understand the risks that you're accepting, and if your wife and family are on board with knowing that you've made that decision for them, like, be your own banker. And in this case, like, if you're not doing IBC, if you're not, practicing some kind of strategy like this, you're not your own banker, but you at least should be in kind of aware of what's happening. If you're making those decisions, okay, well, at least you've thought through it. But if you haven't thought through it before, just reconsider and like take an honest look at what is the asset of your life insured at now. What would you leave behind? Picture that as you're walking around, you're driving and listening to this, and you just get hit and you're gone. Now, all of a sudden, it happens in the next 10 seconds. What is your wife and children going to do? Like, what does their financial future look like now? The importance of thinking about this and planning cannot be overstated here, because we have to prepare for the unexpected. Like we talked about, like, fires aren't unexpected, but flooding in North Carolina, that's unexpected. In Western Carolina, right? Nobody had flood insurance there. And so what happens if the unexpected happens? And again, protect, save, grow. I feel like this is validation for this paradigm that we and others in the IBC community have promulgated, because growing doesn't matter if the protection can wipe it all away. It's a house built on sand. If you're doing this model, the buy term invest the difference model, you're building a house on sand. You have no foundation. It's hard to see, but what we're saying is, as far as how you should be thinking through this, but at least get something out of it.
Yeah, absolutely. I think a lot of people could learn from it if they think past the headlines, which is as deep as most people are going to go. But anyway, man, good discussion.
Yeah, it is.
Reach out to us if you're interested in learning more about how you can better protect your own life and your assets. I mean, we don't do that, but we can definitely point you in some good directions, and we have some thoughts on it. So reach out, info@remnantfinance.com, or go to remnantfinance.com and schedule a call there. with either one of us. Hope to talk to y'all.
Cheers.
See you.